Okay, recording this video after close trade Wednesday, 9th of July 2014. Hope you had a good couple of days trading. Well, I want to talk about something a little bit different in today's video. I want to talk about 4 kick-ass ways to avoid trading small range days. And this little presentation and analysis was prompted by an email I got from Greg the other day. And Greg said, Barry, is there anything you look at early in the day to help you determine whether we are likely to have decent range and volatility during the session? Being able to determine low range cyclical days early would be very helpful. Thanks for your insight. Happy customer, Greg. So, Greg's on the money here because small range days are dangerous for day trading, so finding ways to avoid them is a really good idea. And I always find the reasons why they're kind of dangerous for day trading is a couple of reasons. First of all, there's no room for mistakes. If you're getting in and out on kind of trending moves, you have to be just bang on and to pick out 4 points out of a low range day. On these kind of low range days, Greg talks about cyclicality, and that's exactly right. They're just bouncing backwards and forwards between highs and lows, and there's no real daily trend. And so what I find is I'll be constantly jumping in and out of positions thinking, is this an up day, is this a down day? And when there really isn't a daily trend during that day, I'm always flipping my positions backwards and forwards, which leads to the third problem, a risk of overtrading, because I'm always thinking, is this an up day, is this a down day, and getting a little bit confused with what the market's showing me. I end up overtrading and trading too many times during a small period of time. So all of that is kind of dangerous for your day trading. So small range days, if we can avoid them, is a very good idea. What is a small range day on the E-mini? I always think the cutoff's about 10 points. I mean, luckily in the last 5 years or so, the volatility's gone way up on the E-mini. But if we're looking at anything between kind of 6 to 8 points of range during the day session on the E-mini, that is tight range for me. That kind of smacks trouble. Above 10 points, you can look for kind of good, decent trending moves and pick out a 4-point trade out of that. So in this analysis kind of going forward, think about 10 points being the kind of cutoff points in terms of decent range and low range. So here are the rules of thumb. The first one is if yesterday's range was big, today's range is likely to be small, and the converse holds true as well. So if yesterday's range was small, today's range is likely to be big. And this is the whole idea that volatility and range is cyclical. We move from periods of kind of low activity to high activity and then back to low activity. And what I find is there's actually a difference day by day between periods where we find low activity and high activity. So if yesterday's range was decent and fairly big, tomorrow's range is likely to be smaller. So that's a good way of avoiding a trading day. So we've had one of these kind of monster runaway moves where we get 15-20 points of range during the day's session. Tomorrow's range is likely to be small. So just be wary on days after big ranging days. And here's the little bit of analysis that kind of backs that up. This is using daily range for the last 10 years of E-mini data. Now, because the ranges have varied so much over that 10-year period, what I've calculated here is the ratio between yesterday's range and today's range, and then the ratio between tomorrow's range and today's range. So if we're sitting at today's range compared to yesterday, and it's high, if we're sitting up here on this side of the right-hand side of this chart where we've got positive levels above 1, so today's range compared to yesterday was high, you can see all these data points are kind of low on this chart, which means that tomorrow's range compared to today is going to be less than 1. That's the relationship that you're looking at. So if we're looking at today's range compared to yesterday was high, so we had a big ranging day, tomorrow's range compared to today is going to be smaller. So we're kind of looking at below 1. Here is the ratio. And this little regression line that's been plotted on this point on this chart here just shows that we're sloping from bottom right to top left, which then says that if today's range compared to yesterday was small, so we have a below 1 kind of ratio reading here, because we have all these data points up here, that means that the range of tomorrow compared to today is going to be high. So that's what we're looking at here, this relationship that goes from kind of top left to bottom right, and it's an inverse relationship showing that the range tomorrow is going to be the inverse of the range today. So that's the first rule of thumb. The second rule of thumb then is going down to what's happening after the open of the day. And the rule of thumb here is if today's first 10-minute range is small, the full day's range is likely to be small. And I've looked at data for the first 5, 10 and 15 minutes over the last year, and this relationship holds whether it's 5, 10 or 15 minutes that you're kind of looking at. The point is, in the first few minutes of the day, if you have a quiet day with very little range, it would suggest that the rest of the day is going to be quite like that. So again, here's the data that kind of backs that up, and this is just looking at the last 1 year's data for the E-mini, because we're looking at 5-minute ranges going on here. And what I've looked at is the full day's range in terms of points, and just bear in mind that that 10-point cutoff is the key kind of level here. So here's 10 on this chart, suggesting that's the cutoff for the decent range. And what you see is a lot of data points down here on the left hand side of this chart, saying that if the range in the first 10 minutes is less than about 3 or 3.5 points, that would suggest that the total daily range is going to be less than 10 points. However, you've got all these data points out here which suggest if the range during the first 10 minutes is 3 or more than 3.5 points, the rest of the day's range is going to be pretty decent. It's going to be above 10 points. And again, there's this little regression line kind of plotted here, which is going from bottom left to top right, which is saying there's a relationship between the range during the first 10 minutes of the day, or the first 5, 10 or 15 minutes of the day, and the rest of the day. If the first 5 or 10 minutes is quiet, the rest of the day is going to be quiet. If the first 5 or 10 minutes is active and the range is decent, then we're going to get decent range for the rest of the day. So that's kind of a really handy rule of thumb. So if yesterday's range was big, today's range is going to be small. And then if you're looking at the market for the first 5 or 10 minutes, and if it's really sluggish and slow and very small range during today's session, then the rest of that day is likely to be bad. So if you have those two conditions kind of coming together, yesterday was a big ranging day, and then during the first 10 minutes of today's trade, it's very quiet, bad day to trade. So that's kind of a decent rule of thumb where you're combining those two rules of thumb together. Okay, next one, number 3. Christmas is about the only time of year you should avoid day trading. And this was a little bit of surprise to me, because I always thought that, we have the summer doldrums and it's kind of best not to be trading during, July and August, for example. So what I did is went back over the last 10 years of E-mini history and calculated what the average daily range was by week. So down at the bottom here, we've got week 1 up to week 52, 53. So some years we have 52 weeks, some years we have 53 weeks. So we've got each of the weeks of the year going from January to December going along here. And then during each of those weeks, what was the average daily range during the day? Remember, here's our 10-point cutoff, and pretty much all of those daily ranges during the year was decently above 10. I think the average during this time period for those last 10 years is about 15, 16 points overall. But you'll notice that there isn't really a summer doldrums kind of drop off. There's a little bit kind of mid-year here and a little bit kind of leading into September, October, but it's not pronounced. The pronounced dip in volatility comes at the end of the year. So around Christmas time we really start to drop off. So kind of mid-December onwards, bad time of year to trade. But then at the beginning of the year, the volatility comes straight back in 1st of January. And that's everybody kind of rebalancing their portfolios. A lot of people kind of taking the opportunity to invest kind of new funds at the beginning of the year. But that was a little bit of a surprise to me. Got me thinking, I wonder if the meltdown that we had during 08 had any impact on that volatility. And so I just stripped out all of the data that went from March 08 to February 09, which was when we really got the high volatility days and we kind of had serious meltdowns. And I plotted the two, the original chart that you've just seen, which is the darker blue bars, and then those that trading activity excluding that a year of high volatility trade that we had during the meltdown. And pretty much you can see not much difference in terms of volatility leading up to September, October. Then there was a marked difference in the volatility between what we had during the full 10 years and then without that meltdown kind of stripped out of the data there. But happily enough, the volatility, even without that meltdown data, was still pretty decent. The daily ranges were still kind of around 14, 15 points. The drop-off that we have into December, into Christmas, is still there at the end of the year, but you can see those light blue bars still hold kind of decently above about 14 or so throughout the entire year. So the rule of thumb is about the only period of time that you should avoid day trading is Christmas. So the 2 or 3 weeks kind of leading up into Christmas and around Christmas and New Year. Kind of danger, don't trade during those. But the rest of the year, there are seemingly decent day trading opportunities. Then, during the year, what kind of days should you avoid? And here's another useful rule of thumb. It's the number 4. It's avoid the lead up into long weekend holidays and Fed days. And here we just had, over the last week or so, we had 2 examples of that. We were leading into the 4th of July long weekend, and you can see that on that lead up day to the 4th of July we had a very quiet day, and that was a day that was not worth trading. Also, today was a Fed day, and I want to show you what the typical pattern is on a Fed day and why you should avoid trading them, certainly leading up to the announcements. So each of those type of days and lead-ups kind of look a little bit like this. Now this is just using today's data, Wednesday's data for the Fed day, and it looks at the daily range in terms of point every 5 or 10 minutes during the trading day. So here we go, the first 5 minutes of the day. Day trading starts at 8:30 and we finish at 3:15 in the afternoon, and we've got about 5 points of range during the first 5 or 10 minutes, 15 minutes of trade during that day. Then we get a little bit more volatility up until about 9 o'clock in the morning, and the range kind of sticks here at 7, which isn't bad for that kind of pre-activity. But then the range doesn't increase at all. The highs and lows are set for that day until the Fed announcements comes out at 1 p.m. Chicago time, so 2 p.m. New York time. The Fed announcement, the notes are released, here we go, and there's the volatility, kicks back in. This is what I'm suggesting is the area, the time during the day that you should avoid trading, because we've had the volatility. Any volatility we're going to get on a Fed day or leading up to a long weekend, we're going to get in the first 30 minutes or 45 minutes of the day. After that, danger, it's going to be very difficult to trade. We're not going to get kind of decent moves. You also see the average trade size goes way down during this period. The professionals are not trading, it's just amateurs, trying to make some money, and it's only when the notes are released, when we get Fed announcements, that's when the volatility kicks back in. So we can see leading into the end of the day, the volatility goes way up. Now, today's kind of Fed activity, I reckon that was fairly quiet actually in terms of announcements. We'd done 7 points of range up till then, and then there was only another 3 points of range to take us to 10 points for the full day. Normally, the Fed days are more volatile than that. I would suggest that, and certainly, on serious days. At the moment, the Fed announcements and what the Fed is doing is fairly well telegraphed, and there's nothing major in terms of new news coming out, so it's more kind of confirming stuff. So everybody's taken their points of view on what the Fed is doing. In previous years, though, that was far more uncertain. We had days when there were not shock announcements, but they were kind of seriously market-moving announcements that came out, and so the range that you would see after a Fed announcement would be way more than what we saw, the extra 3 points of range that we saw today. It would be kind of more like 10 points of extra range going on. But anyway, that's the pattern I'm saying. Avoid trading into news from the Fed, and then the same type of thing will be happening on days leading into long weekends and holiday periods, where the range will just go quiet after the first 30 minutes of trade and just flatline for the rest of the day. So avoid those days. Now, last idea was an idea that didn't work. This was an idea that Matt kind of sent me a good while ago now, probably about 6 months ago, so apologies for Matt not getting to this. It was a great little idea. Matt said, what about using the average trade size to determine whether it's going to be a high ranging day or a low ranging day today or tomorrow? And so I looked at that as well, looking at the average trade size. Does that have a bearing on the day's activity and the range? And frankly, there was nothing there. There wasn't really a decent relationship, so I'm going to show you just the 2 charts on that. First of all, this is today's average trade size compared to yesterday. Okay, so was this, the average trade size, was it above or below what happened yesterday? And then compare that with the range of tomorrow. So again, we're using this kind of ratio data because we're going back 10 years of history. So I don't want to use absolute points. I want to use kind of relative comparable type volatility. And you can see that where previously we had a fairly decent line kind of going top right to bottom, top left to bottom right, kind of inverse relationship pointing down. What we've got here is there's a little bit of slope in that regression line, but it's just a big, kind of mess of data just slap bang in the middle, where the ratio between today's trade size and yesterday really could be have no bearing on the range of going of tomorrow. So if today's average trade size was high and it was up here above 1, we're equally likely to have a high-ranging day tomorrow as a low-ranging day tomorrow. So really not much in it. And again, vice versa, if today was an low average trade size day compared to the previous day, what's going to happen tomorrow in terms of range? We've got just as many points above the one line as below the one line. So I would suggest there's very little kind of relationship going there, using average trade size during the day. And then the same kind of analysis looking at the first 5, 10 and 15 minutes of the day. Is there anything going on? So I looked at the average trade size in terms of contracts traded, and again we get a flat line kind of relationship with the full day's range here. So we're just as likely to get a low range day as a high range day kind of going on here with average trade size being low. Remember that at the very beginning of the day, the first minute or so of trade, there's a lot of professional and high average trade size that goes through, so that kind of can cloud the data. So if you're looking and choose to do this analysis yourself, the first 5 minutes tends to be higher average trade size, and then the trade size kind of comes down into the next 5 and the next 15 minutes of trade. And so, looking at 10 minutes here of data kind of makes sense, but the relationship here is pretty flat line, so nothing much kind of going on. So it was a good idea, Matt, thank you for suggesting that, but unfortunately kind of didn't prove fruitful in the end. So what we're left with is our 4 kind of rules of thumb for identifying low range days and avoiding them. First of all, yesterday's range. If yesterday's range was high, the likelihood is today's range is going to be small. Then if the first 10 minutes of today's trade is quiet, the rest of the day is also likely to be quiet. And then during the year, no periods to kind of avoid in terms of seasonality except Christmas time. So it's just the 2 or 3 weeks around Christmas and the New Year. Don't trade those. And then just be very careful leading up into holidays and Fed Day announcements, because they tend to the volatility kind of goes well off before coming into those holidays and Fed announcements. Then on the Fed announcements, you get a decent kick in terms of volatility. So there we go. Hopefully that's helpful to you. 4 rules of thumb to help you avoid trading on small range days.